Good morning, folks. I hope you've had a wonderful week. And thanks for the wonderful feedback that you've given me on last week's weekly wrap. Let's dive into what's been happening this week around the world. So on Monday, we opened with a headline in the Business Standard. Adani Group commits 1,10,000 crores capex for FY26. That's a good number to be doing for a private sector. So far, if you recall, it's the government that has been spending a lot and supporting the GDP, and the private sector has been lagging. So hopefully there'll be more such private sector commitments to increasing capex. Then we have another headline. Jewelry loses luster as gold prices hit a record high, not only in India but globally. So domestic demand for gold has taken a hit as the yellow metal traded at rupees 90,500 to rupees 90,800 per 10 grams in Mumbai's spot bullion market. Okay. So actually, if you look at the data, India imported only 15 tons of gold in February as compared to more than 100 tons last February. On an average, February imports have been about 76 tons every year, every February. But this time it's come down to only 15 tons, showing that gold is becoming unaffordable for the common man. In fact, the article goes on to say, according to a survey done in 2022 by the IIM Ahmedabad's Indian Gold Policy Center, unlike the general perception that only the rich buy gold, 56% of gold was bought by people falling in the income group of rupees 2 to 10 lakh rupees per annum. Since 2022, the price of gold has doubled, but not the savings of these people, and hence their capacity to buy more gold has reduced. Data also shows that at least a third of gold demand globally is towards jewelry. And if jewelry is becoming unaffordable, let's see what happens to gold demand as a whole, and then what happens to its price, which many people think is in an overbought range. This week, strangely, Indian defense stocks lock and load, ready for export offensive, is the headline on Monday's Smart Investor. So the market seems to be thinking that with Europe increasing its defense budget, some of it could percolate to Indian defense companies too. And hence a lot of the Indian defense company stocks went up. The article gives us a good table of net sales and operating profit of all these companies. But looking at this data, the price earning multiples of this group as a whole still seems pretty high. More than a 40x at current earnings, and even on a forward earnings, the Nifty India Defense Index seems to be having a 30.1 times price earning multiple. It is high. If these companies manage to keep the growth up, then only it would be worthwhile. Trump policies spark surge in foreign stocks. So since Trump's inauguration, the S&P 500 has fallen 6%, while the DAX of Germany has risen 10%, and Europe-wide stock 600 index has gained more than 4%. Other US indexes have fared even worse, as European markets have been buoyed by plans for military spending on the continent after Trump made it clear he wants those nations to do more to protect themselves. So the US markets have been outperforming most global markets the last few years. And maybe India has come a close second to that. But the last few months, things seem to have taken a turn, and a lot of capital is moving away from the US stock markets to other stock markets, Europe and China being prominent among them. Okay. So I guess it may be a good idea for global diversification. And that's what the article in Mint also seems to be saying, that investors should be looking at being less concentrated in American stocks as compared to other global stocks. And goes on to give a whole range of ETFs which one can be buying using various stockbroking platforms. Okay. The other interesting suggestion made here is that multi-asset funds can be used to help diversify into global stocks. So in the headline which says global investing made easy, smart strategies for Indians, and multi-asset funds help diversify across equities, debt, gold and global stocks along with tax benefits. Because if you hold it for more than 2 years, as the article says, you're only to be paying a 12.5% long-term capital gains tax, which is not at all bad. It is just like holding Indian equities also. So it says when equities get overvalued, a good multi-asset manager will switch to debt or gold. The argument is similar for international equities. While there are dedicated overseas feeder funds and ETFs, you can take the same exposure via a multi-asset fund that allocates to the US or other markets. And the same page also contains another article, and the headline goes, "Why US market may no longer be the best global bet for Indian investors." So it seems to be the perception that the US markets are overvalued, overbought, and too much attention has been given to the Magnificent Seven companies or the top tech companies in the US. And a lot of data seems to be showing that capital is moving away from these companies. In fact, a number of hedge funds have been selling and moving out of US tech stocks into Europe and even China. So here's something interesting. Coming, storm in the superbike teacup. So here we have an article which says that as in case US reduces customs duties for imported superbikes, then there would be a price fall in superbikes in India. This could happen as a part of the tariff negotiations where India is also supposed to be conceding some to the US. As we all know that the import duties on automobiles and two-wheelers is pretty high. So it goes on to say that the larger motorcycles, those in the 650cc and above category or 500cc and above category, could see a fall in price, especially brands like Honda or Ducati, Triumph, Kawasaki, Harley Davidson, Suzuki, the more popular motorcycles in India, could see some dip in prices. So if you are a superbike aficionado, then good news for you here. On the Thursday's Mint, it opens with a very interesting observation. Currency crossroads, RBI on a tightrope walk. So here the article goes on to observe that it's possible that with the change in the RBI governor, there's also a change in strategy of India's responses to foreign currency, maintaining the rupee's strength or allowing it to weaken. The entire last year, when it was the previous governor Srikanth Bhagavat, it is observed that the rupee was supported, and it was possible that the government did not want the rupee to depreciate. So the Reserve Bank spent a considerable amount of its reserves in keeping the currency afloat. But in the few days that the new governor has taken over, Sanjay Malhotra, the currency is actually, Indian rupee has actually depreciated 2.1%, okay, which is double of what has happened in the previous period. It is believed that possible the new governor has a new strategy in place. But the interesting thing is, the article goes on to say, is what is the impossible trinity? Okay, so what is this impossible trinity? The RBI is also facing the impossible trinity, which means the central bank cannot simultaneously have an independent monetary policy, maintain a stable exchange rate, and also have free flows of capital. Okay, so this requires a little deeper understanding to go into it. So when you try to maintain the rupee at a certain level, you will have to sell dollars and buy rupees. This tightens liquidity. And this is exactly going against the monetary policy attempts of the Reserve Bank, which is to have greater liquidity. The entire last year, we've had pretty tight liquidity, and that has probably impacted growth. And now when we would like to have more liquidity, we cannot do so while keeping a stronger currency at the same time. So if we want to have liquidity, we will have to compromise or sacrifice the attempts to keep the rupee stronger. So one of them will have to be done. In fact, when you compare the Indian rupee's performance against other emerging market nations, we've done very well. Okay, whether you compare against the yuan, the Indonesian baht, or the Mexican peso, or the Brazilian real, Indian currency has been far more stable than these countries' currencies, which is a good observation. Prologis, the US supply chain major, is going to be investing $500 million on warehousing in India. Okay, so this is great for the supply chain industry. Okay. So the San Francisco headquarters Prologis entered India in 2023 after withdrawing plans to operate in the country back in 2007-8 because of the global financial crisis. Okay. Prologis' global real estate portfolio spanned 1.3 billion square feet with $198 billion of assets under management. Okay. So now, to expand and scale up fast in India, Prologis plans to acquire land and build projects from the ground up, as well as to acquire assets. So construction is already underway at the Sri Perumbudur and Hoskote sites and would also begin shortly at Hosur as per Prologis. We will develop the projects mostly on our own and will have partners in some, says Vineet Sheksaria, head of Prologis in India. Okay. This is good news for the supply chain industry in India as it gets more organized and also gives us more opportunities to make investments. Okay. Then this is the next headline. European Union skewers Google and Apple over tech rules despite US threats. Okay, so the European Union defied US threats of retaliation Wednesday by accusing Google of violating its digital rules, which could trigger hefty fines, and ordering Apple to make its iPhone interact better with rivals' devices. So the argument has been that these tech measures, including Google and Apple, are not allowing competition to flourish. Okay, and the fines, if this happens, could be pretty huge. The EU could fine Google up to 10% of its global turnover if Google doesn't comply with the EU. Of course, these legal battles will continue back and forth, but these are some of the risks that are there as in these tech measures, especially with data privacy laws and competition rules becoming more and more stringent. Can we count on manufacturing as an economic growth engine? Asks Madan Sabnavis. Madan Sabnavis is the chief economist of Bank of Baroda and an author also. He's a well-known economist. So he's put forward a fair bit of data here, which shows how the importance of manufacture has actually been reducing in India and being overtaken by services. The share of manufacturing in gross value added at current prices fell from 16.5% in 2013-14 to 14.3% now. So this is how manufacturing has been reducing. And the share of manufactured goods in private final consumption, okay, has fallen from 57.2% to 48.8%. So while we are all talking about supporting manufacturing and making manufacturing the driver of growth in India, we have to bear in mind that the demand for manufactured goods versus services in India has actually been falling, and something needs to be done by the government to boost the supply side of manufacturing. Okay, boost the demand side of manufacturing while the supply efforts remain on. So these are the challenges the government faces while trying to move from services to manufacturing as the platform for India's future growth. So today's newspaper says that certificates of deposits rates top 8% for smaller banks. So as we come to the end of the financial year, there's a great demand for funds by banks who need to balance their balance sheets. And typically the cost of money goes up, the short-term money goes up, and that is why some of these smaller banks have had to borrow at as much as 8% for this period. So you have banks needing to balance their balance sheets, and then you have huge advance tax outflows happening at this time, which makes liquidity a bit tighter in March. And that's why even Geo Finance, which wanted to raise about 3,000 crores as in their maiden bond issue, the headline says that they've postponed the bond issue because of higher interest rates now, and they see softer interest rates going forward. This is a very interesting chart in today's Business Standard. It says, the headline says, global debt exceeds $100 trillion as per the OECD. One should be looking at this number vis-a-vis GDP to give us an idea of where we are. Okay, so some of the larger countries like US, who have about a $35 trillion of government debt accumulated so far, and in the case of the US, their debt to GDP has crossed 100% and is closer to 22% debt to GDP, which is a pretty high number. Okay, and this was below 60% if you went back to 2005. The bulk of the US's borrowing happened post the global financial crisis. It has been shooting up since then, and we have no idea what is sustainable and what is unsustainable. And even the global debt levels, which were only about $51 trillion in 2010, is now become $100+ trillion. And even if you're looking at the global debt to GDP ratio, it is not looking great. This only goes to say that the rate at which governments have been borrowing is much higher than the rate at which the growth is happening. So a lot of it could be unproductive expenditure. We do know that a lot of countries are spending more and more on social welfare, and this could be the outcome of all the things. Also, the article says spending by governments on interest payments reached 3.3% of GDP in its member countries, higher than what they spend on defense. This part of the report, the interesting observation. Also, if you listen to Ray Dalio, who's of Bridgewater, he is of the opinion that whenever the proportion of interest payments is going higher than what a country spends on its defense, that is probably the inflection point of that country being a superpower. Okay, let's see what happens as we go forward. But Ray Dalio always goes back at least 300 years to see how countries have been behaving and makes his inferences from that. This headline has been impacting IT stock prices. This Accenture flags cancellations and delays in federal contracts. So Accenture, it says, has about 8% of its revenue coming in from US government contracts. And given the effort of the Trump administration to cut down wasteful expenditure, we are finding that new contracts from the US government are not coming in as easily, and hence they have been dropping. Accenture foresees a lower growth rate as compared to the previous years because of US government contracts. Markets have moved up during the week, almost 3.69% during the week after many weeks of falls. In fact, last week almost a 7% fall. This is good news because we've endured a pretty large fall in large caps, mid caps, small caps. The mid and small caps suffering more than the large caps, of course. Okay. I think much of the article says that the optimism is coming from the Fed rate policy stance that they could likely reduce interest rates in the coming year, but I'm not too sure how much credence to give to it, because the Fed doesn't really give a forecast, but the dot plot, which is quoted very often, is an indication of how the FOMC members foresee the interest rates to be moving during the rest of the year. By itself, the Fed doesn't give any forecast, but the Fed governor's statement says that if conditions are favorable, then they would reduce interest rates during the year. The Fed is worried about how the new government policies would impact growth and inflation, and hence they're keeping their cards close to their chest and will only act on after observing how data goes. So if there is going to be a slowdown in the US economy, that is when they would probably look at cutting down interest rates. Data so far does not show any slowdown in the US economy. The FTSE, which is the UK index, the FTSE reject set to spur $1.4 billion inflows today. So it says domestic equities are set to receive net inflows of roughly $1.4 billion on Friday from passive funds tracking FTSE indices. As part of its semi-annual review, the global index provider has added over 50 domestic stocks to its indices. These stocks will see passive buying ranging from $4 million to $427 million.